The dollar's continued climb higher has been predicated on a host of factors, including the rise in geopolitical risk and the dollar's safe haven status as inflows have picked up markedly, uncertainty with regard to the Federal Reserve's interest rate move in December, a solid domestic economic landscape with inflation still sticky, a weakening euro as expectations suggest the potential for a stronger rate cut, and questions regarding the inflationary implications of the Trump administration's tariff agenda. With more questions than answers, the dollar's ascent is expected to continue, or level off, until there's more definitive information regarding the extent of tariffs, and on the other side of the equation, the effect of retaliatory tariffs. Global capital markets seek clarity, particularly the currency market. The path and pace of the dollar will be predicated on the flow of information from the incoming administration, especially in regard to trade policy. Markets across the board and globally will be affected, including treasuries and global bonds, equities, commodities, and ultimately the Fed funds futures market as it attempts to decipher how the Fed will interpret and assimilate new information as it anticipates policy. LPL's Strategic and Tactical Asset Allocation Committee maintains its tactical neutral stance on equities, with a preference for the U.S., a slight tilt toward growth, and benchmark-like exposure across the market capitalization spectrum. However, we do not rule out the possibility of short-term weakness, especially as geopolitical threats escalate. Equities may also readjust to what may be a slower and shallower Fed rate cutting cycle than markets are currently pricing in, although both post-election and fourth quarter seasonality are favorable for stocks.